Imagine looking at a company's quarterly results, right, and seeing that they just lost $2.4 billion with a BN top-line revenue.
Oh, wow. Yeah, that's massive.
Right. And not only that, they completely lost their largest customer in this highly specialized, super lucrative vertical.
It's brutal.
And then, just to, add a little more friction, one of their biggest mail order partners drastically reduced their purchasing volume.
I mean, in almost any other industry, under almost any other business model, that specific sequence of events triggers a complete catastrophic earnings miss.
Exactly. Usually the stock creators management issues this groveling apology and analysts just start aggressively downgrading price targets.
But that is not what happened here.
No, it's not. Today, we are looking at a company that took all of those hits right to the chin, shrugged them off, and then, calmly posted double-digit earnings growth.
Blew right past profit expectations.
Yeah. And they even raise their forward guidance.
It fundamentally breaks the traditional financial models that most retail investors rely on,
Totally. Because we're conditioned to believe that revenue is like the ultimate leading indicator. If the top line shrinks by billions, the bottom line is supposed to follow.
Right. It has to, mechanically.
But what we are analyzing today is this masterclass in mix shift. It's a real-time demonstration of a massive corporation intentionally shedding empty, low-margin calories, basically, so they can feast on high-margin protein.
I love that analogy. And that is exactly what we're dissecting today for you. We're doing a deep dive into the fiscal year 2026 third quarter earnings call for Cencora Inc.
Trading under the ticker symbol CRR.
Yes, CHRO. And for those of you who might know them by their legacy name, AmerisourceBergen, this is one of the big three pharmaceutical distributors in the U.S.
Right up there with McKesson and Cardinal Health.
Exactly. So we've got their latest transcript featuring President and CEO Bob Mock and their brand new CFO, Eva Brado. And our mission for this deep dive is to take all the jargon, the analyst questions, all that dense regulatory speak.
And there is a lot of it. And translate it into clear, actionable insights for you. We really want to figure out exactly how Cencora is defying financial gravity right now.
And, to understand the defiance, you really have to understand their structural pivot.
Okay, set the stage for us.
Well, for decades, the business model of a pharmaceutical wholesale distributor was essentially just logistics and volume.
Moving boxes.
Literally moving boxes. You buy massive quantities of pills from Pfizer or Eli Lilly. You stick them in warehouses, load them on trucks, and deliver them to pharmacies.
And the margins on that are tiny, right?
Razor thin. I mean, you might make fractions of a penny on a transaction for a generic pill. So to grow your earnings, you just had to move more boxes. It was a pure industrial scale operation.
But moving boxes is a race to the bottom.
Yeah.
It's completely commoditized, like Amazon can move boxes.
Exactly. And management saw that coming years ago, so they began aggressively pivoting away from just being this middleman for generic retail pills.
Where did they go?
They moved into complex, high-margin specialty care. We're talking oncology, retina specialists, cell and gene therapies, areas of medicine where the logistics are just incredibly complex.
Right, where the drugs are physically fragile, they need temperature control, and administering them takes intense clinical oversight.
Right. Cencora basically decided to stop just delivering the drug and start partnering deeply with the actual physicians who administer them.
Which brings us perfectly to the actual headline numbers from Eva Brado's opening remarks.
Right.
Because the data, it completely validates that strategy.
It really does. Let's look at the raw scale first.
Yeah, so consolidated revenue for the quarter was $84.8 billion.
Billion.
With a B. That's up 5% year over year. $84.8 billion in a single 90-day period. Yeah. Like the amount of physical product moving through their supply chain to hit that number is almost hard to wrap your head around.
It's staggering scale. It places them easily in the very highest echelon of the Fortune 500. But, the revenue number, as massive as it is,
it's actually the least interesting part of the print.
Exactly. The true narrative is in the profitability metrics.
Right, because adjusted earnings per share, the EPS, drove up 12%. Adjusted operating income landed at $1.2 billion, which is a 17% increase.
Strong numbers.
Very strong. And the figure that I just keep circling in my notes is the consolidated adjusted gross profit. That came in at $3.5 billion, which is a massive 23% jump year over year.
Huge jump.
So you have revenue creeping up 5%, but the actual gross profit on that revenue is exploding by 23%. That delta between revenue growth and profit growth, that is the entire investment thesis right now.
And CFO Eva Brado gave us the exact metric that explains that delta. She noted that their gross profit margin expanded by 61 basis points to reach 4.16%.
Okay, let's pause right here.
Yeah.
Because we definitely have listeners who look at SaaS companies, tech stocks, semiconductor designers.
Where gross margins are like 60%, 70%, 80%.
Exactly. To a tech investor, a 4.16% gross margin sounds practically unprofitable. And a 61 basis point increase, which is just 0.61%, sounds like a literal rounding error. So why is Wall Street cheering a 0.61% margin expansion?
It all comes down to operating leverage and just the sheer denominator of the revenue.
Unpack that a bit.
Sure. When you are processing $84.8 billion in sales, a tiny fraction of a percentage point translates into hundreds of millions of dollars in real cash flow.
Right.
In wholesale distribution, your fixed costs are massive. Your warehouses, your fleet of temperature-controlled trucks, the IT infrastructure.
Well, once you pay for all that.
Right. Once those fixed costs are covered by the immense volume of your low-margin traditional distribution business, every incremental dollar of high-margin specialty revenue falls almost entirely to the bottom line.
I see.
So going from roughly 3.5% to 4.16% isn't just a minor bump. It represents a fundamental rewiring of their product mix. It mathematically proves they're selling higher-value services.
Okay, that makes sense. But management isn't just relying on margin expansion to drive that 12% EPS growth, right? They're also utilizing some pretty aggressive capital allocation.
How heavily?
Brado outlined that they spent $1 billion during the quarter to buy back shares at an average price of $268 per share.
Yep.
That brought their diluted share count down to 193.9 million shares. Now, I kind of want to push back on this a bit.
Sure, let's hear it.
So Cencora generated $1.1 billion in year-to-date adjusted free cash flow, but they took on a pretty significant amount of debt recently to execute their M&A strategy, specifically the One Oncology deal.
Right, they did.
In fact, their net interest expense for this quarter was $141 million, which is up $59 million from the same quarter last year.
Right.
So if your interest expenses are climbing that aggressively because of debt, isn't taking $1 billion in cash and using it to buy back stock just in financial engineering?
That's a fair point.
Aren't they just artificially inflating the EPS by shrinking the pie pan so the filling looks deeper, basically masking the cost of the debt?
Look, that is a very common criticism of share buybacks, and it's a completely valid question to ask. If a company is borrowing money at, say, 8% just to buy back stock that yields 2%, they are destroying shareholder value.
Right, it's terrible math.
But that is not what is happening here. You really have to look at their weighted average cost of capital, or WACC, and the intrinsic valuation of the business.
Walk us through the math on that then. Why is this specific buyback a smart move rather than a parlor trick?
First off, Cencora is a cash-generating machine. Despite the debt from those acquisitions, their operating cash flow is incredibly robust, and that's driven by the working capital dynamics of drug distribution.
How so?
They collect cash from pharmacies really quickly while pushing out their payment terms to the manufacturer.
Creating a massive float.
Exactly. So they have this constant, massive stream of free cash flow. Now, management has to decide, what is the most accretive use of this $1 billion?
They could pay down the debt.
They could. But if that debt is locked in at a relatively low fixed interest rate from a few years ago, the cost of servicing it is actually quite cheap compared to the return they can get deploying that capital elsewhere.
Okay, so paying down cheap debt isn't the best use of capital.
Right. Alternatively, they could do more M&A, but as Bob Mauch noted later in the call, they are very disciplined.
They only want tuck-in acquisitions that fit their exact criteria.
Right, pharmaceutical-centric criteria. They aren't going to just overpay for some random asset just to deploy the cash.
So it comes back to the shares.
Yep. By buying back $1 billion of stock at $268, management is sending a definitive signal to the market. They're basically saying, we have run our internal discounted cash flow models, we see the margin expansion coming from our specialty businesses, and we firmly believe our own stock is fundamentally undervalued.
Got it.
By retiring those shares, they permanently increase the proportional ownership of every remaining shareholder. It's highly efficient capital allocation when you execute it at the right valuation.
And it certainly mechanics the EPS upward to hit that 12% target, which, keeps the institutional investors very happy.
Definitely.
But let's look at the other side of the ledger for a second, because to truly appreciate that 12% EPS growth, we need to thoroughly understand the massive headwinds they had to absorb to get there. Let's quantify the damage they shrugged off.
It was substantial.
Yeah.
In their U.S. Healthcare Solutions segment, they finally lapped the loss of a major customer, Florida Cancer Specialists, which departed back in July of the previous year.
And losing a major oncology network means losing a huge volume of highly lucrative specialty drug flow.
Right. Furthermore, they experienced a notable decline in sales to a large mail-order customer.
But the absolute behemoth of a headwind was the manufacturer list price reductions. I mean, Eva Brado explicitly called this out as a $2.4 billion negative impact to revenue growth.
That's a huge number.
For a lot of retail investors, this is counterintuitive. Why are drug manufacturers suddenly slashing list prices by billions of dollars? And mechanically, how does a manufacturer's price cut actually hurt the distributor?
So to understand the list price reductions, you really have to look at the political and regulatory environment over the last 2 years.
Right, the pressure has been intense.
Exactly. There has been intense bipartisan scrutiny on the cost of legacy medications, particularly insulins. Manufacturers have faced massive public pressure, congressional hearings, the threat of severe legislation.
So they acted preemptively.
Yes. Several major pharmaceutical companies preemptively slashed the stated list prices of their insulins and other heavily utilized older branded medications by 70% or more.
Okay, so the manufacturer drops the price of a vial of insulin from, say, $300 to $35. How does that translate to a $2.4 billion hole in Cencora's revenue?
It comes down to how wholesale distribution contracts are historically structured. In the traditional model, a distributor like Cencora buys the drug from the manufacturer at a percentage discount off the wholesale acquisition cost, or WAC, which is basically the list price.
Okay.
They then sell it to the pharmacy at a slightly smaller discount off that list price. Their revenue is intrinsically tied to the absolute dollar value of that list price.
Right.
If a drug costs $1,000 and Cencora takes a 2% cut, they book $20 in gross profit, but they book the entire $1,000 as top-line revenue when it passes through their hands.
Ah, I see. So if the manufacturer slashes that list price to $100, Cencora's top-line revenue immediately drops by $900 on that single transaction, even if the physical volume of vials they are shipping remains exactly the same.
Precisely. The $2.4 billion revenue headwind is largely an accounting reflection of these lowered list prices.
But here's the critical distinction, right?
Yeah.
And the reason why Cencora's profits actually went up despite this top-line destruction.
Right. Over the last decade, Cencora has aggressively renegotiated their contracts with manufacturers. They have moved away from being purely dependent on a percentage of the list price and shifted toward fee-for-service agreements.
Define a fee-for-service agreement in this context for us.
It means Cencora goes to the manufacturer and says, regardless of what you charge for this drug, we are providing a highly valuable logistical service. We are managing the cold chain. We are handling the inventory carrying costs. We are providing data analytics on prescription trends, and we are managing the distribution to 50,000 pharmacies.
So they want to be paid for the service itself.
Exactly. You need to pay us a flat negotiated fee for that service, separate from the fluctuating list price. So when the manufacturer cuts the list price of insulin, Cencora's top-line revenue plunges, but their actual fee for moving that insulin remains relatively stable.
So the top line takes a $2.4 billion hit, but the gross profit is largely protected. That is a brilliant evolution of a business model. I mean, they successfully decoupled their profit engine from the political volatility of drug pricing.
It really is.
But protecting the baseline profit is one thing, right?
Right.
Actually growing operating income by 17% requires a massive catalyst. And that brings us to the cultural and pharmaceutical phenomenon of the decade. The GLP-1 agonists.
Oh, absolutely. You cannot talk about healthcare earnings in 2026 without talking about the GLP-1s.
No way.
These are the blockbuster diabetes and weight loss injectables, drugs like Ozempic, Wegovy, Mounjaro, Zepbound. The demand curve for these products is unlike anything the pharmaceutical industry has ever seen.
It's wild.
Eva Brado noted that sales for GLP-1s increased by an astonishing $2.3 billion year over year.
Yeah, and during the Q&A, Eric from Baird zeroed in on this. He pointed out that adding $2.3 billion in incremental revenue implies growth in the low to mid 20% range for this specific category.
Which is massive.
And Eva Brado confirmed it was roughly 25% growth. And remarkably, she said this was generally in line with their internal expectations.
They saw it coming.
But let's look at the mechanics of this, because we just talked about how list price drops hurt top-line revenue.
Yeah.
GLP-1s are incredibly expensive, often listing around $1,000 a month. So they are single-handedly propping up the revenue number. But are they actually driving that margin expansion?
That is the pivotal question. And the answer is complex.
Okay, unpack it for us.
GLP-1s are a massive driver of absolute gross profit dollars simply because of the sheer unprecedented volume.
It's just moving that much product.
Right. The logistical effort required to move an extra $2.3 billion worth of temperature-sensitive, highly sought-after injectable pens is monumental. Cencora earns fees for handling that volume safely and efficiently.
Okay, so that's the absolute dollar side.
However, from a margin percentage perspective, GLP-1s are actually somewhat dilutive.
Wait, they're dilutive to the margin? Why? If they're the most popular drugs on Earth, shouldn't they be highly profitable for the distributor?
Because of the channel through which they are distributed, GLP-1s are overwhelmingly considered Part D retail drugs.
Part D, right.
Patients get a prescription, they walk into a CVS, a Walgreens, or an independent pharmacy, and they pick up a box of pens that they inject themselves at home.
Right, it's a consumer transaction.
And for retail pharmacy distribution, the margins are inherently compressed. It's a high-volume, low-margin transaction. Cencora provides the logistics, but they don't provide a deep layer of clinical support or complex billing services for a drug you just keep in your butter compartment at home.
Okay. So if the GLP-1s are driving massive revenue but compressing the margin percentage, what exactly is driving that 61 basis point margin expansion? Where is the high margin protein actually coming from?
The engine driving the profitability, like the absolute star of the quarter, is their specialty platform. Specifically, their management services organizations, or MSOs.
MSOs.
Yes. This is where Cencora transcends being just a distributor and becomes an indispensable healthcare partner. They highlighted two massive assets in their portfolio during the call. One Oncology, which they recently acquired, and RCA, which stands for Retina Consultants of America.
I really want to spend significant time on this because this feels like the entire thesis for owning the stock. For a retail investor who doesn't spend their weekends reading Medicare reimbursement codes, let's break down exactly what an MSO is and why a company like Cencora wants to own one.
Let's look at it from the perspective of an independent, community-based specialist.
Okay.
Let's say you are a brilliant oncologist. You spent 15 years in medical training. You want to open a clinic in your community to treat cancer patients close to their homes.
Sounds like a noble goal.
You open the doors, and almost immediately you realize you are spending 70% of your time on business administration, not medicine.
Right, because you suddenly have to run a highly complex corporate entity.
Exactly. You have to hire and manage an HR department. You have to implement an impossibly complicated electronic health record IT system.
The paperwork alone.
You have to negotiate reimbursement rates with multi-billion-dollar commercial insurance companies who literally have entire teams dedicated to denying your claims.
It's a full-time job.
But the most crushing burden is the drug procurement. To treat your patients, you have to buy incredibly expensive chemotherapy and biologic agents.
Out of pocket.
You have to purchase these drugs up front, store them in highly regulated temperature-controlled environments, infuse them into the patient, and then wait 60 to 90 days for Medicare or private insurance to reimburse you.
Wow.
You are essentially carrying millions of dollars of inventory float. And if you make one coding error on the billing, the insurance company denies the claim and your clinic just eats the cost of a $15,000 drug.
That sounds like a fast track to bankruptcy for an independent practice, which I guess is why we see so many community doctors just throwing their hands up and selling their practices to massive hospital systems, right?
Exactly. And when community clinics get absorbed by massive hospital systems, the site of care shifts.
The patient has to go to the hospital.
Right. The patient now has to drive to a massive hospital complex. And crucially, the hospital charges a facility fee, which drastically increases the cost of the exact same treatment for both the patient and the overall healthcare system.
Enter the MSO.
Enter the MSO. A management services organization like One Oncology approaches that exhausted independent oncologist and says, look, we want you to maintain your clinical independence. You make 100% of the medical decisions. But we are going to take over the entire back end of your business. We will implement state-of-the-art IT. We'll handle the HR. We'll manage the complex billing revenue cycle. And most importantly, we will use our massive national scale to aggregate purchasing power and negotiate significant discounts on those wildly expensive oncology drugs.
And Cencora owns these MSOs. They literally own the entity that manages the clinics.
Right. So Cencora isn't just selling drugs to these clinics as a third-party vendor anymore. They are deeply embedded into the operational fabric and the financial success of the clinic itself.
So they're capturing value at multiple steps.
Exactly. They capture the margin on the drug distribution, they capture the margin on the GPO, the group purchasing organization discounts, and they capture management fees for running the business operations. It creates this incredibly sticky, high-margin ecosystem. Bob Moak was incredibly enthusiastic about this ecosystem during the call. But this brings up a massive point of clarification, and it gets deep into the weeds of healthcare jargon.
Let's do it.
During the Q&A portion, Glenn Sanangelo from Barclays asked a very specific question about the specialty business, and he divided it into Part B versus Part D drugs.
Yeah, that was a key moment.
And Bob Moak was very candid. He essentially stated that Part B drugs are fundamentally more important to Cencora's profitability than Part D drugs.
Absolutely.
We need to dissect this because if an investor doesn't understand the difference between Part B and Part D, they really cannot understand Cencora's valuation. What is the mechanical difference, and why does the margin profile heavily favor Part B?
This is perhaps the most important concept for anyone investing in the healthcare supply chain. We touched on Part D earlier with the GLP-1s. Part D stands for Medicare Part D. It covers prescription drugs that the patient administers themselves. You get a script from your doctor, you go to a retail pharmacy or use a mail order service, you pick up a bottle of pills or an inhaler or a pre-filled pen, and you take it at home.
Okay, self-administered retail setting.
Right. Now, in the Part D world, when a very expensive brand name drug loses its patent and a cheaper generic or biosimilar version enters the market, it is generally fantastic for the patient and the healthcare system because costs plummet.
But for Cencora,
However, for Cencora, Part D generics are a volume game. Furthermore, Cencora provides very few wraparound services for a Part D drug. If a massive mail-order pharmacy decides they want to source a Part D generic directly from the manufacturer to save a few pennies, they can bypass Cencora entirely. That is actually one of the headwinds management called out this quarter, a shift in mail-order purchasing. So Part D provides massive revenue, but it is highly competitive and susceptible to disintermediation.
okay, so then we shift to Part B.
Part B covers medical insurance, and crucially, it covers complex drugs that must be administered by a physician or a clinician in a clinical setting. We are not talking about pills in a bottle here.
What are we talking about?
We're talking about complex, temperature-sensitive intravenous infusions for chemotherapy. We are talking about specialized biologics that are injected directly into a patient's eye by a retina specialist for macular degeneration.
The logistics and the risk profile for those drugs are on a completely different planet.
Exactly. This entire process is known in the industry as buy and bill.
Buy and bill.
The community clinic actually buys the drug from Cencora. They store it in specialized medical refrigerators. They administer the infusion to the patient over several hours in a clinical suite, and then the clinic bills Medicare or the commercial payer for both the drug and the administration service.
And this is where Cencora's MSOs and all those wraparound services become indispensable.
Indispensable is the perfect word. For a Part B drug, Cencora isn't just dropping a cardboard box on the loading dock. Through their core distribution, they are guaranteeing the unbroken cold chain for a highly fragile biologic.
Okay.
Through their GPO, they are negotiating the purchase price so the clinic can actually afford the inventory. And through the MSO like One Oncology or RCA, they are providing the highly specialized clinical software that tracks the inventory, ensures the patient's insurance will actually cover the specific biomarker indication for the drug, and manages the labyrinthine medical billing process so the doctor actually gets paid.
Bob Moak made this incredibly clear. He said there's a significantly larger profit opportunity in Part B, precisely because Cencora plays a vastly larger role in how these drugs are assessed, handled, utilized, and built.
The complexity is the moat.
Yes, the complexity is the moat.
And here is the kicker regarding biosimilars in the Part B space. In Part D, a cheap generic compresses the absolute dollar margin. But in Part B, when a biosimilar enters the market to compete with an expensive biologic, it creates intense competition among manufacturers to win the clinic's business.
And Cencora is sitting right in the middle of that.
Cencora, acting as the GPO and the MSO for thousands of clinics, controls that market access. They can negotiate incredible rebates, administrative fees, and volume discounts on those Part B biosimilars, massively expanding their own profit margins while simultaneously lowering the cost for the clinic and the patient.
It's a win-win-win that is highly insulated from competitive threats.
It really is.
It's an absolutely brilliant structure. If Part D is like a consumer buying a replacement windshield wiper at an auto parts store and installing it themselves in the parking lot, Cencora just gets a tiny retail markup. But Part B is like a consumer bringing a high-performance sports car into a specialized luxury garage for an engine rebuild. Cencora is providing the high-end parts. They built the diagnostic software for the mechanic, they manage the inventory for the garage, and they process the final invoice.
Exactly.
The profit pool is exponentially deeper.
That analogy perfectly captures the value differential. And this strategic pivot toward complex, high-margin specialty logistics, it isn't just a domestic phenomenon. It is actively driving massive growth in their international healthcare solutions segment as well.
What are the numbers there?
Eva Brado highlighted that international revenue was $7.7 billion for the quarter, which is up 6%. But the critical number is the operating income, which surged by 23% on a constant currency basis.
Okay, let's do a quick translation for the retail investors on constant currency basis. It's a phrase that multinational companies throw around on every single earnings call, but it's important to understand the math behind it.
It's essentially a way of mathematically stripping out the noise created by fluctuating foreign exchange rates.
Because they operate globally.
Right. Cencora operates globally. If they do business in Europe, they earn revenue in euros. When it's time to report earnings in the U.S., they have to translate those euros back into U.S. dollars.
And if the dollar is strong?
If the U.S. dollar has gotten significantly stronger over the past year, those euros translate into fewer dollars, making the revenue look artificially weak. Constant currency essentially tells investors, if the exchange rates had stayed perfectly flat compared to last year, here is what the actual operational growth of our business looks like.
It allows you to judge the true health of the business unit without being distracted by macroeconomic forex markets.
Exactly. And 23% operational profit growth is spectacular.
It is phenomenal growth. And management specifically called out strength in their European distribution business, but they spent a lot of time highlighting their global specialty logistics businesses, specifically naming European 3PL and a subsidiary called World Courier.
World Courier.
Now, World Courier sounds like a fictional shell company from a spy movie. What exactly is World Courier and why are they driving 23% profit growth?
World Courier is perhaps one of the most fascinating and high-stakes businesses in Cencora's entire portfolio. Bob Mauk elaborated on this when analyst George Hill from Deutsche Bank asked a pointed question about the competitive landscape in global logistics.
What do they do?
World Courier does not move pallets of generic aspirin. They handle the absolute highest-end, most hyper-specialized logistics for pharmaceutical manufacturers, primarily focusing on global clinical trials and advanced therapies.
We are talking of the cutting edge of medical science here, cell and gene therapies.
Exactly. Imagine a pharmaceutical company is running a clinical trial for a personalized autologous CAR-T cell therapy for leukemia.
Sure.
The process is mind-bending. A doctor extracts T cells from a patient in a hospital in London. Those living cells must be immediately frozen and transported across the globe to a specialized manufacturing facility in, say, New Jersey. In New Jersey, scientists genetically engineer those cells to attack cancer, freeze them again, and ship them back to the exact same patient in London for infusion.
And the margin for error is absolute zero.
Absolute zero. The cells must be maintained at negative 80 degrees Celsius the entire time. There is a strict 48-hour viability window. The chain of identity must be flawless. You cannot infuse the wrong engineered cells into a patient.
I mean, if the temperature fluctuates by a few degrees on a tarmac in Heathrow.
Or a customs form is filled out incorrectly. A customized therapy worth upwards of $500,000 is instantly destroyed, the clinical trial data is compromised, and most tragically, a patient with terminal cancer loses their lifeline.
Right.
World Courier provides the specialized, zero-failure logistical network that ensures that does not happen.
So the barrier to entry for competitors is astronomically high. You can't just be FedEx or UPS and decide you want to move CAR-T therapies tomorrow.
Bob Mauk made that exact point. George Hill asked about broader logistics competitors entering the space, specifically mentioning companies like ICS. Mauk acknowledged there are credible competitors, but he stressed that Cencora wins these contracts because of their overarching pharmaceutical-centric strategy.
Meaning they know the space inside and out.
Right. They are not a massive generalized freight company trying to figure out medical compliance on the side. They are a deep-rooted pharmaceutical expert that purpose-built a highly specialized logistics arm.
They understand the regulatory filings, the clinical trial protocols, the physical chemistry of the payloads.
To a pharmaceutical manufacturer risking billions of dollars on a phase 3 clinical trial, that deep domain expertise is worth paying a massive premium for.
It creates a beautiful narrative thread connecting all their business units. The U.S. segment is dominating specialty Part B logistics and MSO management, effortlessly digesting GLP-1 volume and list price volatility. Meanwhile, the international side is delivering hyper-specialized, high-margin, zero-failure logistics for the global clinical trials that invent those very specialty drugs.
It is a cohesive, highly profitable ecosystem.
Which leads us perfectly into the third crucial element of any earnings call: management guidance. Where are Eva Brado and Bob March steering this massive operation for the remainder of fiscal 2026 and as they look out toward 2027?
Guidance is where the rhetoric meets reality. It's where management puts their money where their mouth is, and Eva Brado delivered a highly confident outlook.
What were the numbers?
They raised their full-year fiscal 2026 adjusted EPS guidance to a new range of $17.75 to $17.95. They also raised the bottom end of their consolidated operating income growth expectations, bringing the new range to 13% to 14%.
But I want to highlight a fascinating discrepancy in her guidance remarks, because this is exactly the kind of nuance retail investors need to catch.
Oh, the revenue guidance.
Yes. While she confidently raised the profit expectations across the board, she explicitly kept their U.S. revenue growth guidance unchanged at 4% to 6%. But she went a step further and actively warned analysts that actual revenue will likely land in the lower half of that 4% to 6% range.
Yep.
So we have a scenario where the CFO is actively tapering down revenue expectations while simultaneously raising profit expectations. How do we interpret that?
It is the ultimate validation of the exact thesis we've been discussing for the last 30 minutes. It proves, in hard guidance numbers, that they are perfectly comfortable sacrificing low-margin revenue volume because their high-margin specialty business is wildly outperforming. If a massive mail-order pharmacy decides to insource the distribution of a low-margin Part D generic, Cencora loses a massive chunk of top-line revenue, which pulls that growth rate into the lower half of the 4-6% range.
But because the margin on that lost revenue was fractions of a penny,
it barely leaves a scratch on their operating profit. Meanwhile, their MSOs One Oncology and RCA are performing ahead of expectations, delivering double-digit organic operating income growth. They are aggressively trading empty revenue calories for high-margin operating protein, and the guidance mathematically reflects that strategy.
To understand the sustainability of that high-margin protein, we need to dive deep into the integration of One Oncology. Cencora spent billions acquiring this MSO back in February.
It was a massive deal.
Elizabeth Anderson from Evercore ISI asked a phenomenal, highly structural question about this. She wanted to know the specific operational improvements and the phased timeline of the integration. She's essentially asking, you bought it, now how are you actually extracting value from it over the next 3 years?
And Bob Moat laid out a highly strategic 3-phase value creation thesis. Let's break those phases down.
And go for it.
It was one of the most clarifying answers on the entire call. Phase 1 is the immediate mechanical integration of the MSO into the broader Cencora ecosystem.
The blocking and tackling.
Exactly. This is the blocking and tackling of M&A. It means migrating the clinics onto Cencora's proprietary IT systems, consolidating the back-office operations, and immediately moving the drug procurement onto Cencora's GPO contracts to realize immediate purchasing synergies.
Which they've done with RCA already, right?
Mach noted they have made significant, mature progress on RCA, and they are executing very well on the early stages of One Oncology. It's the foundational work that stabilizes the asset.
Once the foundation is stable, he outlined phase 2, which is sharing capabilities across the entire platform. And the massive growth vector he highlighted here is clinical trials. This completely shifts how I view their business model.
It is a profound shift in the healthcare landscape. Historically, if a pharmaceutical company wanted to run a clinical trial for a cutting-edge cancer therapy, they would partner with a major academic medical center, think MD Anderson in Texas, or Memorial Sloan Kettering in New York.
Makes sense.
The problem is, The vast majority of cancer patients do not live within driving distance of an elite academic medical center. They live in suburban or rural communities. Therefore, pharmaceutical manufacturers face a massive multi-million-dollar bottleneck: patient accrual.
Getting people in the door.
Finding enough demographically diverse patients with specific genetic tumor profiles to enroll in a phase 2 or phase 3 trial is incredibly difficult and drastically slows down the drug development pipeline.
It's a geographical barrier to innovation.
Exactly. Cencora recognized this bottleneck and realized that through their MSOs, they possess the solution. Cencora provides the IT and data analytics backbone for thousands of independent community oncologists.
Oh, wow, they have the data.
They have real-time visibility into the localized patient populations. By building clinical trial infrastructure directly into these community practices, Cencora bridges the gap. They can go to a pharmaceutical manufacturer and say, you need 50 patients with a specific HER2 positive breast cancer mutation. We can identify them across our network of community clinics in Ohio, Florida, and Arizona, and we provide the software and compliance infrastructure for those local doctors to run the trials safely.
That is incredible. They are decentralizing clinical research, bringing the trial directly to the patient's local doctor, which Bob Mosh noted is the most cost-effective and accessible site of care.
Yep.
Charles Rye from TD Cowen asked a great follow-up on this, trying to gauge how much runway is left in this specific strategy. He asked what inning they are in regarding this clinical trial build-out.
Mosh gave a very nuanced answer. For RCA, the retina MSO, he said they are in the later innings. It is a mature, well-integrated platform that is already executing trials effectively.
And for One Oncology?
He stated they are still in the very early innings. The potential upside there is staggering because the sheer volume of clinical research and innovation happening in the oncology pipeline dwarfs almost every other medical specialty. They have a massive runway of growth just by integrating trials into the One Oncology network.
And then Mosh touched on phase 3, which is developing entirely net new services. He talked about leveraging their massive data lakes to provide advanced analytics, predictive insights, and novel software solutions for both the community physicians and the pharmaceutical manufacturers.
It paints a picture of a company that is evolving from a distributor into an indispensable healthcare technology platform.
But as with any corporate evolution, it is not entirely blue skies.
Yeah.
Eva Brado wanted to ensure analysts had their financial models calibrated correctly for fiscal 2027, and she laid out a specific structural speed bump we need to analyze.
Yes, she flagged the pending merger of their MWI animal health business with Covetrus.
Okay, let's stop and pivot hard for a second. We have spent the last 45 minutes talking about autologous CAR-RT cell therapies, human oncology clinical trials, and macular degeneration injections. Why on earth does Cencora own a massive animal health and veterinary distribution business, and why are they choosing to merge it now?
It is a legacy asset from a different era of the company. Historically, the physical mechanics of distributing vaccines, antibiotics, and surgical supplies to veterinary clinics were not drastically different from distributing them to human pharmacies. It was all part of being a massive diversified logistics entity.
But as we have discussed, Cencora's modern strategy is intensely focused on highly complex human specialty care.
Exactly. The Part B buy and bill ecosystem, the MSOs, the advanced clinical trials, an independent veterinarian treating a golden retriever is not participating in a decentralized human clinical trial for a $500,000 biologic.
Right.
The synergy just isn't there anymore. The animal health division, while profitable, had become a strategic distraction. It diluted the purity of their pharmaceutical-centric human specialty thesis. So in February, they reached a definitive agreement to merge MWI Animal Health with Covetrus, creating a standalone joint venture.
But the financial mechanics of that spinoff are what Eva Brado needed the analyst to model correctly. She explicitly guided that if the transaction closes at the midpoint of fiscal 2027, it creates a $150 million operating income headwind within their other reporting segment.
Because mechanically, once the merger closes, Cencora will deconsolidate that entire business unit from their core financials. They will no longer claim that $150 million in operating profit on their own income statement.
Makes sense.
However, Brado was careful to note that the structure of the deal includes significant upfront cash and equity in the new joint venture, which partially offsets the economic impact of the earnings headwind. But strictly from an EPS modeling standpoint, she warned it will net out to roughly a $1.35 hit to earnings per share in 2027.
This is a classic textbook example of corporate pruning. Management is willing to take a short-term, highly visible accounting hit, sacrificing $150 million in operating income and $0.35 of EPS in order to streamline the long-term strategic focus of the entire corporation.
Wall Street tends to reward pure-play companies with higher valuation multiples than conglomerate, diversified businesses.
Precisely. They are shedding a non-core asset to double down on high-margin MSO strategy. But doubling down on community oncology and retina specialists brings us face-to-face with the massive, unignorable elephant in the room for any healthcare stock: the federal regulatory environment.
Oh, yeah.
Before we dive into this, I want to establish a very strict parameter for our listeners. Healthcare policy in the United States is intensely polarized and deeply political. As analysts, we are remaining entirely politically neutral. We are not taking a stance on the morality, the efficacy, or the political philosophy behind any of the legislation we are about to discuss. Our sole objective is to impartially analyze how these specific government policies mechanically impact Cencora's business model and the financial health of the community clinics they manage.
That is a crucial distinction. The regulatory environment dictates the flow of hundreds of billions of dollars in this sector. During the Q&A, several prominent analysts, including Alan Lutz and Kevin Caliendo, aggressively probed management about impending changes to government policies.
They specifically drilled down on two massive acronyms: the 340B program and the IRA changes to ASP calculations. Let's translate those acronyms, starting with 340B.
Okay.
The federal 340B drug pricing program was created in 1992. The fundamental intent of the law was to require pharmaceutical manufacturers to provide steeply discounted outpatient drugs to eligible covered entities, which are primarily safety net hospitals and clinics that serve highly vulnerable, uninsured, or low-income populations. The idea was to stretch scarce federal resources.
The intent was noble, but over the last 30 years, the mechanics of how the program is utilized have evolved drastically, creating massive friction between manufacturers, hospitals, and independent clinics.
Where is the friction point exactly?
Here is the friction point. A qualifying 340B hospital purchases a highly expensive oncology drug from the manufacturer at a massive federally mandated discount. However, if they administer that drug to a patient who has commercial insurance or Medicare, the hospital bills the insurance company at the full normal reimbursement rate.
And the spread.
The hospital then pockets the massive spread between the discounted purchase price and the full reimbursement price.
This has allowed massive hospital systems to generate immense profits, which has driven intense frustration from pharmaceutical manufacturers who feel the program is being exploited beyond its original safety net intent. But how does this specific battle between pharma and hospitals impact Cencora and their independent MSO clinics?
Because independent community oncologists, the doctors Cencora partners with through One Oncology, are generally not 340B covered entities. They have to purchase the drugs at standard prices. If regulatory changes or manufacturer restrictions alter the flow of 340B discounts, it creates intense volatility in the broader supply chain pricing dynamics.
But the more acute regulatory threat that analysts focused on is the IRA and the ASP calculations. IRA refers to the Inflation Reduction Act, and ASP stands for average sales price.
Let's get deeply technical on ASP, because it is a linchpin of the entire Part B buy and bill business model we discussed earlier.
Remember how we explained that an independent clinic buys the expensive drug, infuses it, and bills Medicare?
Right.
Medicare does not just pay whatever the doctor asks. Medicare reimburses the clinic based on a strict formula. The average sales price, or ASP, of the drug across the entire market, plus a small percentage markup, historically ASP, plus 6% to cover the storage, handling, and administration costs.
So the clinic's entire profit margin for administering the drug exists within that small percentage markup above the ASP.
So the math is incredibly sensitive. If the government calculates that the ASP has gone down, the total reimbursement to the doctor goes down, which compresses the doctor's margin.
Exactly. And the concern from Wall Street stems from the new regulations within the Inflation Reduction Act. The IRA allows Medicare to negotiate drug prices and demands massive rebates from manufacturers if they raise prices faster than inflation.
Okay, so where does the fear come from?
Analysts like Kevin Caliendo from UBS explicitly asked Bob Mauch, if manufacturers are forced to give massive discounts or rebates to the government under the IRA, will those discounts be factored into the mathematical calculation of the average sales price?
Oh, because if they are, the ASP plummets.
Right, which means the community oncologist gets reimbursed significantly less, which means Cencora's MSO business suffers a massive financial hit. Caliendo basically asked, is this an existential risk to your MSO strategy?
It's the multi-billion-dollar question. And Bob Mauch's response was fascinating. He was highly confident. He stated that Cencora's leadership team spends a tremendous amount of time in Washington, D.C., heavily engaged with policymakers.
Yep.
And his core thesis was that while they monitor all policy closely, they firmly believe the policies currently under consideration are intentionally designed not to negatively impact physician reimbursement.
His logic is grounded in the macroeconomic realities of the healthcare system. He pointed out to the analysts that federal policymakers clearly understand that independent, community-based physicians are the most accessible, highly rated, and ultimately the lowest cost site of care in the entire ecosystem.
Right, because if Medicare accidentally regulates the community oncologist into bankruptcy by compressing their ASP reimbursement, that oncologist closes their clinic and goes to work for the massive consolidated hospital system down the street.
Precisely. And when the patient follows the doctor to the massive hospital, the hospital charges Medicare that massive facility fee we mentioned earlier, and suddenly Medicare is paying drastically more for the exact same treatment.
Mauch argued that the government is acutely aware of this dynamic and is actively trying to protect the community clinics from unintended collateral damage. And he provided a specific piece of evidence to back up that confidence. He explicitly referenced a regulatory pilot program called the GLOBE Demonstration Project.
The GLOBE project.
Can you unpack the mechanics of the GLOBE project and why Mauch views it as a massive positive signal?
The GLOBE project, which stands for the Medicare Part B Drug Payment and Rebate Demonstration, is a proposed framework by regulators to handle these new IRA manufacturer rebates.
Good.
The critical, highly technical detail that Mauch highlighted is the proposed flow of funds. Under the GLOBE framework, the massive discounts or rebates that the manufacturer owes to the government will not be applied at the wholesale level, and they will not flow through the traditional supply chain reimbursement formulas.
Meaning they won't drag down the average sales price calculation.
Exactly. Instead, the manufacturer will effectively write a direct check to the government on the back end to settle the rebate. The stated list price in the market, and crucially, the calculated average sales price that Medicare uses to reimburse the local doctor, remains insulated and intact.
I see. So the manufacturer pays the penalty directly to CMS, the Centers for Medicare and Medicaid Services, but the community oncologist still gets reimbursed based on the higher historical ASP formula. The doctor's margin is protected.
That is the goal. Mauch views the architecture of the GLOBE demonstration project as tangible proof that policymakers recognize the fragility of community physician economics and are actively engineering solutions to ensure their reimbursement is not negatively impacted.
He stated very clearly that as they model their business looking toward 2028 and the full rollout of these IRA rules, they feel highly confident in the stability of their MSO ecosystem.
Cencora is actively lobbying to ensure that patient access and the financial viability of cost-effective community care remain the focal points of any finalized regulations.
That deep dive into the regulatory plumbing is incredibly clarifying. It explains why management remains so bullish on capital deployment. And that brings us to a great question from Erin Wright at Morgan Stanley.
What does she ask?
She essentially asked, in light of all this regulatory maneuvering, complexity, and uncertainty, is the juice still worth the squeeze? Is Cencora going to continue pouring capital into acquiring more MSOs?
And Bob Mauch's answer was an unequivocal yes. He reaffirmed their aggressive long-term outlook for the community physician space. He stated they absolutely intend to continue investing via strategic tuck-in acquisitions to expand both the RCA Retina platform and the One Oncology cancer platform.
But he did add a very important caveat about discipline when Erin Wright asked if they would consider expanding into entirely new medical specialties. She asked, are you going to look at other abologies beyond cancer and retina?
And this brings us full circle to their core identity. Bob Mauch reiterated that Cencora intends to remain strictly pharmaceutical-centric.
What does that mean for their M&A?
They analyze the medical landscape and look for specialties that are overwhelmingly reliant on highly complex physician-administered pharmaceuticals, those Part B buy and bill infusions and injections. Right now, oncology and retina are the two dominant specialties that fit that precise profile. They are not going to go out and buy a massive orthopedic MSO or a dermatology MSO or a physical therapy network just for the sake of top-line revenue growth.
Because an orthopedic surgeon makes their money performing surgery in an operating room, not by managing a massive inventory of complex biologics. There is no pharmaceutical supply chain leverage for Cencora to exploit in orthopedics.
Exactly. They will only expand into a new specialty if that specialty undergoes a scientific revolution and becomes highly pharmaceutical-centric. It is a highly disciplined, deeply logical approach to capital allocation that ensures they don't stray from their core competency.
Speaking of discipline and capital allocation, I want to highlight the tone set by the new CFO, Eva Brado. She has only been in the seat for about a month, taking over for the long-tenured Jim Cleary. An analyst asked about her specific philosophy on guidance and cash deployment.
And her answer was essentially steady as she goes.
Right. She committed to internal investments to drive organic growth, disciplined strategic M&A within their criteria, opportunistic share repurchases based on intrinsic value, and a consistently growing dividend. She isn't looking to reinvent the wheel. She wants to optimize a machine that is already running exceptionally well.
And the machine is definitely humming. Toward the end of the Q&A, Lisa Gill from JP Morgan tried to pin Bob Mauch down on fiscal 2027 expectations. She noted that the street is currently modeling 14% growth for next year, and she asked if he was comfortable with that number.
Did he give a straight answer?
While he technically deferred giving official quantitative guidance until the November earnings call, his qualitative tone was immensely confident. He firmly reiterated his belief in their long-term guidance algorithm and the structural durability of their specialty platforms. They are projecting massive strength from a position of deep operational leverage.
Which brings us to our final segment of the deep dive. The bottom line. We have spent, an hour dissecting WACC calculations, the physics of autologous cell therapies, the friction of 340B pricing, and the mechanics of Medicare ASP reimbursement.
It's a lot of data.
We've thrown a massive amount of data at you.
Yeah.
But for the retail investor listening to this, what is the final opinionated verdict on Cencora's stock, ticker symbol, COR, after this Q3 print? How should an investor view this company right now?
If you are looking at the execution, the strategic discipline, and the structural resilience of the business, the verdict has to be decidedly bullish. And the rationale is not just because they beat EPS by 12% or raised guidance. The bullish thesis is based on the fact that Cencora is successfully executing one of the most difficult maneuvers in corporate finance, a structural pivot of their core identity in real time under immense external pressure.
Right. We are watching a corporate evolution happening right before our eyes. They're actively shedding the skin of a commoditized, volume-based middleman, the entity that just moved cardboard boxes of generic pills from a warehouse to a pharmacy for fractions of a penny in margin.
They are transforming into a high-value, deeply embedded, indispensable technological and operational partner for the most complex community specialists in the healthcare system.
And the data proves the pivot is not just a slide deck presentation. It is reality. The fact that their multi-billion-dollar acquisition of One Oncology is already performing ahead of internal expectations, the fact that they drove a massive 61 basis point margin expansion on an $84 billion revenue base, and the fact that they are aggressively building out a decentralized clinical trial network. It proves their strategic vision is yielding massive, tangible cash flows.
And as an investor, you have to revere how this management team handles adversity.
We opened this deep dive talking about the hits they took.
Right. They ate a $2.4 billion revenue crater from politically driven list price reductions.
They absorbed the loss of their largest oncology customer from a year ago.
They navigated a structural shift in mail order purchasing volume.
And despite all of that gravitational pull trying to drag their earnings down, they utilized their fee-for-service contracts, leaned heavily into their Part B specialty growth, opportunistically deployed $1 billion in free cash flow to buy back undervalued stock, and still confidently raised their full-year earnings guidance. It demonstrates incredible resilience. They have fundamentally decoupled their profit engine from the volatility of raw revenue volume. When you have a management team that can seamlessly navigate Byzantine Washington healthcare policy, utilize massive scale to protect community doctors, and drive double-digit operating income growth in the face of billions of dollars in top-line headwinds. You are looking at a management team executing at the absolute highest level of the industry.
To put it in the simplest terms, they are aggressively trading the cheap, high-volume, low-margin calories of Part D retail distribution for the highly complex, massively profitable, high-protein reality of Part B specialty care and clinical logistics.
And as a long-term investor, you generally want your capital invested in the protein.
Perfectly summarized.
But before we wrap up this deep dive, I want to leave you, the listener, with a final provocative thought. Something for you to actively mull over and research as you watch this company report earnings over the next few years.
What is that?
Well, because as we've discussed in granular detail today, Cencora is integrating deeper and deeper into the very fabric of healthcare delivery. They are running the decentralized clinical trials, they are providing the specialized EHR software, they are managing the revenue cycle billing, they are sourcing the complex biologics, and they are guaranteeing the zero-failure logistics of cellular therapies. So here's the overarching question. At what point do they slowly cease to be a distributor entirely?
It is a fascinating existential question for the company.
Think about the mechanics of what they're doing. If you own the data analytics, if you run the clinical trials that invent the drugs, if you manage the back office operations of the clinics, and you completely control the supply chain of the complex biologic therapies being infused, are you actually becoming a massive decentralized healthcare provider that effectively owns and monetizes the last mile of complex disease treatment in America?
And if they are actively becoming a healthcare technology and services platform, how should Wall Street value them?
Exactly.
It fundamentally changes the entire investment thesis and the mathematical valuation model. Historically, a logistics and distribution company trades at a relatively low price-to-earnings multiple because it is a low-margin volume game.
Right.
But a next-generation healthcare technology, data, and specialty services platform trades at a vastly higher premium multiple. If the market begins to fully realize that Cencora owns the last mile of specialty care, they aren't just distributing the future of medicine. They are actively shaping, controlling, and profiting from how it is delivered.
That multiple expansion represents massive potential upside for the stock.
It really does.
That is the narrative to watch incredibly closely as they continue to report throughout 2027 and integrate these MSO platforms. Remember, a broken bridge is easy to spot, but a massive corporation successfully rebuilding its entire foundation while the traffic is still flowing at $84 billion a quarter. That requires a much closer look. Keep analyzing the numbers, keep questioning the consensus narrative, and always look for the hidden story behind the headline metrics. Thanks for joining us on this deep dive.